Hello and welcome to episode 2 of Weapons of Mass Construction. I'm Bob Teska, partner in charge of construction services at Bowers Company CPAs. Today I want to present to you part 1 of a 2-part series on the new revenue recognition standards that was effective for publicly traded companies with calendar year ends as of 12/31/18 and for privately held companies with a calendar year end of 12/31/19. The new standard replaces all previously issued industry and transactional specific guidance with very few exceptions, mostly for the leasing and broker-dealers industries. The driving force behind the change was a desire to have clearer and more comparable data for investors. Many industries like construction had industry-specific revenue recognition. For contractors, we had percentage of completion. Tech companies had their own way of recognizing revenue. Energy companies had another way, and the list kind of went on and on. Because of this, investors could not accurately compare companies across industries to make investment decisions. Topic 606, the new revenue recognition standard, was created to solve this issue, creating one standard to recognize revenue across every industry, or I should say most industries. So with that, let's get started. So I'm going to start off today with giving you your takeaway. In case you zone out during the presentation, you'll at least have this to fall back on when you're still paying full attention. Under current, where it says current GAAP, that was really the old standard. New GAAP is the new revenue recognition standard. And what I want to point out here is that when your contract is signed, under both instances, you have $0 of revenue. And when the contract is completed at 100%, you have, under both revenue recognition standards, you have $1 million of revenue. The thing that changes, as you can see, as the contract is being completed, the way the revenue is being recognized, it's a little delayed under new GAAP, and it's a little accelerated under old GAAP. And this is just an example. It's not necessarily how it would go. But the only part we're talking about here is that what changes is really the gray area as the contract's in process. The beginning of the contract is going to be 0, and at the end, you're going to end up with the same amount of revenue. So it gets you to the same place. It just might get you there a little bit differently. So your second takeaway here is going to be that if you don't have a flip phone from 2004, you personally have been affected by the new revenue recognition standard. And you're probably going to ask yourself, how is that possible? Excuse me there. I don't know if you guys remember, but back when you used to get a cell phone, you'd go in, you'd sign a cell phone contract, and your phone would just kind of be part of the contract. It was kind of the hook to get you in. Hey, if you sign up for a new deal with Sprint, you'll get the new iPhone 3 at the time, probably. And, that was just kind of part of the cost. But now when you go to get your new phone, there's a contract piece, your monthly contract for phone service, and then they're selling you the phone separately. And that's because of something that we'll get into called a performance obligation, and the phone companies needed to be able to recognize revenue under the new revenue recognition standard. So it's actually created a situation where it's affecting you personally. Where you now have a piece of your phone bill that is for service or the delivery of your ability to make phone calls and text messages, but also the hardware piece where they're selling you that phone usually over time. So currently, or under the old revenue recognition standard, really, it's very rules-based. It's black and white. There's kind of right and wrong. GAAP consists of broad revenue recognition concepts. And it's specific for industry. Like I said, construction, we've been recognizing revenue on a very specific percentage of completion basis, and it's different in other industries. And probably one of the most dramatic things that we have is that there's decades of litigation to support positions that you're going to take. You don't have to wonder, well, geez, if I do this, would that hold up in court? Is this, kind of an outlier situation? We know because everything has pretty much been litigated, so there's support there for any position that you want to take. On the horizon, or really with this new revenue recognition standard, there's going to be an elimination of all this transaction and industry-specific guidance, and it's replaced with more of a principles-based approach, which is kind of in line with the international accounting standards, and it's more touchy-feely as opposed to how American GAAP has been, where it's been very rules-based, black and white. The core principle behind this is that an entity should recognize revenue to depict the transfer of goods or services to the customer in an amount that reflects the consideration to which the entity expects to be entitled to in exchange for those goods and services. Translation there is, you should recognize revenue on the outset in an amount that you actually expect to receive from your customer based on the services or the goods that you are transferring to them, or as you're delivering them. So the good news here from a 10,000-foot view is that percentage of completion is still alive and you can still use an inputs method like cost to cost. You can use an outputs method if you were a highway contractor, miles paved. When the concept was first discussed of the revenue recognition, the new revenue recognition, it looked like percentage of completion was going to completely go away. That is not the case. So we are going to still have percentage of completion, and you're going to recognize revenue as you transfer goods and services to a customer. So that can be at a point in time, or it can be over a period of time. And so for most contractors, it's going to be over a period of time. Like I said, very similar to the percentage of completion that we all know and love. So how did we get here? Well, there are two main accounting standard setting organizations. There's the FASB for the U.S., and then there's the International Accounting Standards Board, which is pretty much the rest of the world. Long time ago, they tried to do this thing called convergence, where they tried to take both sets of accounting rules and push them together so that there was only one accounting standards throughout the whole world, and that didn't really work. So what they ended up deciding to do was, anytime a new standard was issued, they were going to try to issue a converged standard, or standards that were relatively identical for the U.S. and the international standards. So as we move forward in history, the standard setting body is going to do more and more and more alike. So the FASB and the International Accounting Standards Board worked on this project for about 12 years. In 2010, they issued this first exposure draft, where it's essentially a draft of the new proposal. They send it out to all the public accounting world, people that work in industry, and said, hey, here's what we're proposing. And then the way our industry accounting works is, when the FASB puts these exposure drafts out, it's our job as peers to review them and then send in comment letters. Basically, either support or against it, or maybe you should tweak this. In general, not a lot of people actually send back comment letters. Some of the larger firms actually have departments where they have people that will respond to every new exposure draft that comes out. But by and large, most public accountants go through their whole career and never send in a comment letter. However, with this, when they first did their exposure draft, they received almost 1,000 comment letters. It's the most letters ever to be sent to the FASB about a proposed standard. So because there was such response, and most of it wasn't positive, the FASB and the International Accounting Standards Board did a series of outreach to talk to public accountants and those in industry. They went back, redrafted it, did a second exposure. There were more comment letters. They did another series of outreaches. So what eventually happened in May of 2014, after about 12 years of work, the FASB and the International Accounting Standards Board jointly issued the new revenue recognition standard. There were very, very minor differences between what was issued for FASB and the international standards. Like I said, it was relatively converged. So it was issued, and in some ways, life will never be the same again. As I said at the outset, this has been in effect for public companies, those with calendar year ends in December. They issued under the new accounting RevRec standards for 12/31/18, and for private companies, technically it's in effect right now. When you see statements come out for 12/31/19, it should be under the new RevRec. So what is the new RevRec standard? It is a 5-step model that on this slide looks relatively simple. And we'll just kind of go through this quickly here. The first step is identify if you have a contract. And if you do, then you identify the contract's separate performance obligations. You can think of a performance obligations as a deliverable within the contract. From there, you determine the transaction price. After that, you allocate that transaction price to your separate performance obligations. And then, when you've done that, you recognize revenue as you satisfy those performance obligations. So, as I said, it looks kind of benign on the outset, but as you get into some of the details, it's a little more challenging than it can look. So, now we're going to start walking through the 5 steps. The first step here being identify, do you have a contract or not? So, a contract has to be approved and the parties are committed to it. It can be written or oral. Obviously, we highly recommend it being written. The contract has to identify the rights of each party. It's got to be clear what's being given and what's being received. I'm going to build a building. You're going to pay me $1 million. The payment terms have to be clear. There also has to be commercial substance in the contract. You know, one example they give in the standard is you can't loan funds to a client to buy a product to boost their sales. You know, that there's no commercial substance there. That would just be to inflate numbers to look good for investors. And then something that's new is you have to consider, you know, to have something that rises to the level of a contract, you have to consider, are the proceeds from this contract going to be as collectibility probable? That seems kind of funny because why would you enter into a contract where collectability isn't necessarily probable? You know, because you could have, in this instance, you could actually have a legal contract, but not a accounting contract. What would be deemed a contract under this new RevRec standard if you weren't certain, probable, if it didn't seem probable you were going to be able to collect what was owed to you. So you might think, you know, why would you ever enter into a contract where you weren't certain or, you know, thought it was incredibly probable that you were going to be able to collect? You know, there are situations that happen. I can think of one where there was a developer that was building a mall. He got about 60 to 70% done, and he terminated all of most of the contractors that were working on the mall, subsequently didn't pay them, and then hired new contractors to finish the project, you know, the 30 or 40% that was left to be finished. So if you look at that and you knew it was going on, you know, if you knew that that developer hadn't paid the contractors that worked on the first 60 to 70% of the project, you know, how, you know, what is the probability that you're going to get paid for the portion that you're doing? You know, are you going to end up being litigated like the initial set of contractors were? You know, so that could be a situation where it was like, geez, I don't know if collectability is probable. You know, and that's a difficult situation to be in. Then we look at contract modifications. This is what was formerly known as a change order. And so you have to decide, is a change order just in addition to the existing contract, or is it a separate contract? So a change order is going to modify your original contract that effectively changes the provisions of the contract without adding new provisions. So maybe you were going to build a pool in a pool house, and the pool was going to be 40 feet long, and they were like, you know what, you know, we want the pool to be 45 foot long now. You know, that extra 5 foot of pool isn't going to more than likely rise to the level of being a separate contract. It's just an amendment to the contract that you already had, and so that would be a change order. Same thing if you were making modifications to the pool house. You know, instead of you know, granite countertops in the pool house, we want quartz countertops. You know, that's not a separate contract. That's going to be what's called a contract modification now, or, you know, as previously known as a change order. In most cases, a change order or contract modifications, it's going to be accounted for as a revision to the existing contract, not a separate contract. Under each situation where you have a contract modification, you're going to need to evaluate to determine if it's a distinct and standalone selling price. Meaning, again, is it a separate contract, or are we just where it would have its own pricing, or are we just adding to the additional contract that we do have? So now we're going to move on to identifying performance obligations. A performance obligation is a distinct promise or to provide a good or service to a customer in a contract. So think of a performance obligation as a deliverable. You know, one of the easiest examples that they gave to the in this guidance was if you were hired to renovate or build a school track and field facility, and also hired to renovate or build a pool, and that was all in one contract. You know, you have more than likely two performance obligations within that contract, because you can deliver the track portion without ever starting work on the pool portion, and vice versa. You can deliver the pool and not the track. So within that one contract, you have two deliverables or two performance obligations. So a promise or a group of promises becomes a separate performance obligation when it's distinct from other goods and services within the contract. So in the example I gave, again, you know, you've got a promise to deliver a pool and a promise to deliver a track and field facility. One contract, but two promises or performance obligations within that contract. To be distinct, the good or service has to have utility to the customer. So again, we could use the pool without ever using the track and field, and vice versa. And the promise to transfer the good or service to the customer is separately identifiable from the other promises in the contract. Again, it's enumerated within the contract. You're going to build a track facility. You're going to build a pool facility. So just a couple of examples to think through here. General contractor completes the building envelope. Is that a performance obligation? You've got 4 walls up and maybe some windows. You know, we would say no to that, because that's not separately identifiable within the contract, and there's really no utility to just having 4 walls. So that wouldn't be a performance obligation. If you were hired to build 8 virtually identical Army housing barracks, this would be a series contract. How many performance obligations do you have there? 1 or 8? This is actually a bit of a trick question, because there's a carve-out for this. If it's a series contract like there, it actually would be 1 contract, not 8. And then the example I've been using here, renovating the school track and pool, more than likely there, because you have 2 deliverables that are distinct from each other, you would have 2 performance obligations. You know, where this gets tricky is if you are a design build contractor. The design portion will probably rise to a level of a separate performance obligation than the build piece, because you can design, and that could be a separate deliverable, and then you can build, again, the separate deliverable, and there could be multiple deliverables within the building portion depending on what you're doing. All right, so I'm not going to read this example here, but you can. But essentially what's going on here is you have an engineering construction company, and you have a unit that does fabricating, and then another unit that does construction services, and they were hired to construct a bridge, of which the fabricating department is doing a ton of off-site fabricating, delivering it to the job site, and it's being installed by the construction unit. And the question is, do you have 1 deliverable building the bridge, in which the whole job encompasses the fabricating and the installation, or do you have 2 deliverables? Are you fabricating? Is that a deliverable? And then you're building, that's the second deliverable. If you go down to the bottom there, the risk of fabrication of the individual components of the bridge is inseparable from the risk associated with the construction of the bridge. You know, to put that into common terms here, you know, you can't build the bridge without the fabrication. So it's 1 performance obligation in this situation. So then another example here is, you know, sometimes you might have maybe cookie cutter, design to build like a code generation plan or something. And, you could put that and use that design pretty much anywhere. But, the thing that would change would be the engineering that would have to customize based on the terrain that you're putting it in. And so, what this one goes into that if you don't have a distinct good or service, if it significantly modifies or customizes another good or service in the contract. Essentially, the engineering it takes to install this code generation plant at the different locations that you might install it or build it would just kind of add to the performance obligations you have. So you wouldn't have two performance obligations there. So how would it look on the WIP? More than likely what you're going to do is you are going to split the performance obligations up, even if you have one contract. So you can see you got a really small WIP schedule here, but we've got the mountain climbing school pool rehab is going to be obligation 1, and then the mountain climbing school track rehab is obligation 2. And what is that? It's probably like a $3.2, $3.3 million contract. One contract, the two performance obligations, and it's put on the work in process schedule at its obligation level, not at the contract level. So there's been some questions about this from the surety community about, we're bonding a, $3.5 million contract. We'd like to see that value there. However, the accounting standards are saying, you have to track this by performance obligation. So you're probably going to see the performance obligations broken out separately, maybe subtotaled. I did not subtotal on this example here, but that's more than likely what you're going to see on your work in process schedules going forward if you have separate performance obligations. And I will say this, that the larger and more complex the contractor is, the more likely you see more of these different performance obligations. If you're a specialty sub and you are hanging sheetrock, more than likely that contract you have to hang sheetrock isn't going to be broken up into separate obligations. You're just going to have one performance obligation. Same thing for if you are the electrical or HVAC guy on the job, that is probably going to be just one performance obligation. Now, if you're a GC on a large job like here, where you're the GC and you're doing the pool and the track, again, you could have separate performance obligations. If you are a design build guy, you're more complex and larger projects, you're probably going to see separate performance obligations on the WIP schedule. All right, so this is going to be the end of part 1. I appreciate you logging in and listening to this. Part 2 is coming up. And I realize there is a lot of information here, and it's a little difficult to convey just over the internet here. So if you have specific questions, please feel free to reach out to me. My email's here, my phone number's here. I will definitely get back to you. So stay tuned for part 2.